One of the things I thoroughly enjoy about this channel as it grows is I can bring you new faces with new stories with new data. Today, we've got the one and only Eric, who runs a business cycle research firm. I got to tell you, I don't know what that is, but I'm excited to learn. Eric, thank you for being here. Why don't you go ahead and introduce yourself and what your firm does?
Yeah, thanks for having me on, Michael. The business cycle is the period of expansion and contraction in the economy. Most people know them by those gray bars that show up in all of the charts that we all look at, right? And what we do as a business cycle research service is we provide a sequential framework. So when the economy goes through a business cycle, which is an expansion and a contraction, there's a order of operations or a sequential process that happens. And it happens in the same order every single time. Now, the leads and lags between step one, step two, and step three can be a little bit different, and there can be some nuances, but the sequence or the order of operations is the same. So what we do is we provide that sequential framework to our clients, which are primarily hedge funds, private equity firms, high net worth investors, as well as some corporate management teams like real estate development or construction, to help them spot what the next step in that business cycle sequence would be. And what most people are primarily concerned with is the probability or progression towards recessionary environments, because that's ultimately what has the most chaos in asset prices or whatever people are mostly doing with their business cycle research. So that's what we do. That's the research we try and put forward. And we do a fair amount of work on housing as well, because housing is so critical to that sequential business cycle process.
Yeah, I mean, housing has been known to lead and lag the business cycle, so we're definitely going to poke at housing. But I want to stay at the macro level first, and it's really interesting when you look at the macro level. It's really a good idea to identify the inflection points in the economy early, and if you can do that successfully, you can obviously save a lot of pain, but you can also, more importantly, make investments as it's hitting the other inflection point in coming out of this. So I'm curious, lots of people have been calling recessions for the last couple of years. I, for one, have called a recession twice and been wrong. I'm curious, what are you looking at today? Is a recession call out there? Do you see something in 2025 or 2026? What are you seeing today?
So the problem that's emerged with this cycle, and it's been as difficult for me as anybody, is that when we came out of the pandemic, or actually let's go a little bit before the pandemic. Before the pandemic, for the last 20, 30 years, the economy would grow at, let's say, an average of about 2%. And there is a sequential sort of sine wave or ebb and flow that would happen around that 2% level.
Yep.
The economy wouldn't grow at 2% every year. It would grow at 3%
Yeah.
one year, 1% another year, and it averages out to 2.
Yep.
So when the growth rate is about at that 2% level, whenever the deterioration or the rate of change would occur and you'd start to slow and you go from 2 to 1, there's not much room before you get to a recession. So whenever you'd have a period of economic deceleration, recession would come rather quickly. What happened after the pandemic, because of all of the stimulus and the money that was put into the system, we pushed the growth rates to in really 21, like 10, 11% for a couple of quarters.
Yeah.
And the analogy you could use is, if a plane is flying at 30,000 feet and it starts to descend, it takes whatever, to hit the ground, right? But if you start that descent from 100,000 feet, you can be decelerating for a long time and not hit the ground. And that's really what's been happening. Is the economy had this huge boom coming out of 21, 22. And by the time we got to the middle of 22, that was the peak in the rate of change of the cycle. And that's when all of the quote unquote leading indicators started to come down, was in the middle of 2022. And by the way, those leading indicators are still coming down today.
Yeah, they are. Yes.
So we've been in this deceleration, which people have properly notified as a deceleration, but it's taken a really, really long time for that sort of excess above where our normal trend growth is to come down. Now we've kind of gone back to trend growth, and now we're slipping a little bit below trend. So the recessionary conversation is still on the table. It hasn't gone away, despite the fact that the elapsed time from the rate of change cycle peak to now has been really long. And it's mostly a function, in my opinion, of how far we pushed growth and profit margins and everything above its normal trend level, that it's taken a long time.
You mean throwing $8 trillion into the system has consequences? Is that what we're talking about?
Yeah. It had, certainly predictable consequences. And I think, everyone can also admit that it had a lot of unintended consequences that were difficult to predict, right? There were, in economics, there's, the unknown and the unknown, right? There are all the things that are easy to predict, but then there's the second, third, fourth order consequences that actually can be quite challenging to predict.
No, absolutely. Well, let's stay on the GDP front. We're actually going to go to inflation next, but obviously Q1 GDP came out. I think it's been revised to -0.2. It originally came out at -0.3. GDP now, if you happen to look at that, I think still has Q2 GDP over 4%. Is this all just import-export nonsense, or what do you think Q1 to Q2?
Yeah, so a lot of that noise in the GDP now is related to import-export, trade war, things like that. There's pull forwards and all of that. So what we do to sort of get around some of those issues is, and I'm not being political at all. This is just the way it is that a recession is not defined as 2 quarters of negative GDP, despite what people think, and despite the political conversation that's engulfed that definition. If you go to the National Bureau of Economic Research, which is the agency that dates these business cycles, they have on their website the criteria that they use. And they use 6 monthly indicators in addition to GDP and GDI, which is the sister of GDP. Those 6 monthly indicators are non-farm payrolls, the household survey of employment, real manufacturing, trade and sales, real personal consumption, industrial production, and real personal consumption. So we have income, consumption, production, and employment, what you call the 4 corners of the economy.
Yep.
A recession has to engulf, and the definition is a decline in economic activity that's seen across income, consumption, production, and employment that lasts more than a few months. The reason it has to engulf all 4 of those components is because that's what makes it self-fulfilling. So if you have less income, you have less consumption. If you have less consumption, you have less production. If you have less production, you have less employment. If you have less employment, that feeds back into less income, and the cycle feeds on itself until an outside force, like let's say the Federal Reserve, intervenes and drops interest rates to try and break that cycle. So what happened in 22 when we had those 2 negative quarters is we were still printing like 400,000, 500,000 payrolls.
Crazy, yeah.
So it really wasn't a recession because it wasn't that self-fulfilling spiral that we had. And now we're in the same situation with these GDP now numbers where they're all over the place. If you kind of strip that out and you look at those 4 corners, income, consumption, production, and employment, which we do, the economy is growing right now at about 1.9%, which is basically smack on that trend. It's been pretty stable there, although we also look at subsets of the economy like construction and manufacturing, which are starting to show some signs of legitimate contraction in terms of residential construction, manufacturing. So the aggregate economy, as we call it, is growing at about 1.92%. But the earlier, more cyclical subsets of the economy are starting to show signs of contraction.
It's going to be interesting because one of the things that I put out there actually on January 20th is I said, folks, you got to buckle up. The first 6 months of this administration are going to be chaotic. Little did I know that was a wonderful call at the time. No idea where this,
right?
Yeah, no idea how great that call was. But it's also interesting to note that we're about 6 weeks away from July 20th. Obviously, we're recording this on June 11th. And it appears a trade deal with China may be on the cusp of being signed, and uncertainty is deteriorating. So I think it's going to be really interesting if you look at those subsegments. I don't know, 6 weeks from now, did they have a snapback? Did they have a bounce back? And obviously, we can just roll into inflation. Obviously, the CPI print came out this morning. It was better across the board as far as each month-on-month and year-on-year number, given expectations. You could still also say, if you want to be negative, that CPI headline went up, right, the first time in, I don't know, 12 or 18 months. So again, if you want to be a doomer, you could say that. But the threat of tariffs, at least thus far, is not showing up in inflation. I think it's showing up in demand destruction. And the last thing I'll throw out there to you is, I thought the most shocking economic metric from the last month was personal savings. Personal savings the previous month was 0.6. I think it jumped to like 4.6, which really goes to my point that consumers are scared because of the uncertainty. What do you think of all that? Inflation, savings? What do you think?
I think that you outlined it quite well. Tariffs are not automatically inflationary. You know, inflation is an increase in the price of all goods and services. And
Correct.
I like to make the distinction between what we experienced during COVID and sort of the tariff inflation. So when they put a lot of excess money into the system, people were able to absorb higher prices on all items simultaneously
Correct.
because there was
Correct.
so much extra money to go around.
Well,
If
not
you
only extra money, but let's not forget also less expenses. That was the magic sauce of this. Don't pay
Sure,
your student loans. Don't do this. Don't do that. Suddenly you're
absolutely.
awash in this discretionary income, which you didn't plan for, right? People in America for the longest time probably had $50 in discretionary income. You
For sure.
suddenly stop paying your student loans, stop doing this, stop doing that, and get free money. You feel rich. And guess what they do? They have no discipline. They
Yep.
spend, spend, spend.
And you can absorb higher prices on your whole basket of goods, right?
Exactly. Doesn't matter.
Um,
It's free money.
so, to the extent that you don't engineer huge increases in money, if the price of one good goes up, let's say the price of a car goes up and your discretionary or disposable income stays flat, you can't simultaneously absorb a higher price for that car and a higher price for something else. So what has to happen is the price of another good has to go down to compensate for it.
Mhm.
Or, as you mentioned, you just consume less cars, right? That's the
Correct.
demand destruction element of it. So tariffs at its surface level, of course, would cause an increase in the price of the good being tariffed, but it doesn't automatically translate to an increase in price for all goods. That would somewhat be determined by how much extra money they're putting into the system as well, which at this moment they're not, because the Fed is staying relatively tight. They're still doing quantitative tightening. Money supply is growing at about 3 or 4%, which is a little bit below the long run average. So tariffs aren't immediately inflationary, and I agree with your assessment that on balance, the way we're looking at it now is it would be net demand negative.
Yep.
So you may have a price increase for some goods, but you have a reduction in demand for other goods. So that's the way that I see the tariff situation playing out, which is not surprising to me that it's not showing up super forcefully in the CPI just yet. The other thing that we know from the CPI is that almost all of the residual inflation above 2% is coming from the shelter component.
Shelter, shelter, shelter. Yep.
Yep, exactly. And I don't say this at all to dismiss the extremely intense shelter inflation that we all experienced, because that was real and intense and it hurt a lot of people. There's no question.
Mm.
But as it stands today, rent or shelter is coming in at about 3.5% in the CPI calculation, and the real time number is, of course, lower than that. But
Well,
this is
yeah,
sort of the flip
this-
side of what happened before, right? Where it was
Mhm.
understated, now it's
Correct.
overstated, right?
Yeah.
So, the inflation that happened was real, but there is
Yeah.
a lag in the methodology in which they're calculating the CPI.
I
And
got to ask. I have to ask, because I would have thought when I looked at the calculations last year that by this time shelter would still not be showing over 3%. And again, this is important because it's the largest contributor to CPI. I think
right,
it's 37% or whatever it is.
right.
Um, when is this going to be washed out? I mean, is it going to happen this year? Is it next year? Is it when does
Well,
shelter actually get
yeah,
accurate?
it's going to keep coming down month after month after month. So there is going to be a drag on the CPI. It is going to be pulling the CPI down for at least the next 12 months,
Oh
but
wow,
the
12 months.
speed is still going to be slow, and we don't have a ton of really great evidence for why it's been so slow, because this has kind of been the first explosion in shelter CPI that we've had in a long time. But you being in the real estate industry, you know quite well, there's a couple of there's a couple of interesting dynamics that are going on in the shelter or housing space. Number one is that the rate of inflation is way lower for multifamily apartment than it is for
Correct.
single family.
Correct.
Single family inflation or rental inflation is legitimately probably still 2, 3, 4%.
Agreed. And
Something like
I've said as much. Yep. Agreed.
the multifamily is negative, right? And
Correct. Negative. Yes.
negative. And there is a weighting that goes into that CPI where they're trying to capture all of it, and depending on the measure you use, right? Some people like to use the Zillow measure, some people use apartment list, and they're all over the place depending on the concentration between single family and multifamily. So that's one big difference that is a little bit different this time, because this cycle, especially post-COVID, came with so much multifamily building, a lot of less single family building.
Okay.
The second thing is that what we saw in the pandemic was a lot of really long leases. People would lock in 24-month leases, which was, and there are metrics that are published by some of the agencies that track the average length of lease, and it has extended quite a bit. It's definitely the highest of all time. Sure. Average, I think it's slipping my mind, but I think it averages up to like 15 or 16 months average lease. So that's another reason why it's kind of gone through slowly. And then the last point that I would make is that I don't have a huge issue with the way they're calculating it, because I don't believe that the shelter measure was designed to conduct monetary policy off of. They're trying to actually capture what is the average rate of inflation for the average person out there. And not everyone's rent resets every month. So, some people probably are experiencing 3 or 4% if they just rolled over and they had an increase, while some people have negative. And these are hard problems to solve, and we love to beat up on the agencies that calculate them. But the design of the measure was trying to actually capture what's the average inflation for the average person, not what's the marginal rate of inflation, which may be more appropriate for monetary policy. So we do have to give them a little bit of leeway there, in the sense that not everyone has negative rental inflation at the moment. Well, it is prevalent somewhere.
Yeah, you can give them grace. I'm not going to give them grace, but you did bring up an excellent point that I had not thought of, is that lease duration. Right. I think you're right. The lease duration going from, maybe it was 12 or 13 months to 15 or 16 months. That is impactful. That was a nugget for sure. So I appreciate that. So again, it sounds like what you're saying, do not let me put words in your mouth. I'm just trying to summarize where we are. You don't see a recession. I'll just say this. You don't see a recession in 25 is what I hear. I think I hear you saying.
Yeah, I would be surprised. Well, let me rephrase that. The economy is slowing. The economy is decelerating. And when you're decelerating, by definition, you're moving closer to recession every month, right? Because that's the direction of travel that we're moving.
Correct.
So we are definitely moving closer to that recession. The thing that gives me pause about how immediate the recession may be is that recessions need to come with job losses. And job losses always come first in the categories of residential construction and manufacturing. And we're still only seeing a very limited amount of job losses there. So if we're not seeing widespread job losses there yet, the chances that it proliferates into a broader recession is not super close, in my view. So as the job losses get more intense in those earlier cyclical categories, I would be more willing to put a recessionary forecast more in the near term. I do think, though, however, we will start to see more job losses in those categories, and that'll continue pushing us in that direction. But I do need to see those first. And I just want to give the viewers some context. I go back to the 2008 cycle, not because I think this will be like 2008. It's just the last legitimate business cycle that we had. You have to exclude COVID for obvious reasons. Job losses started in the construction and manufacturing sector in the middle of 2006.
Is this the chart we're looking at? You want me to bring it up?
No? I don't have that in there yet. Okay. I don't have the construction there yet. But just the point is that the cyclical categories of the labor market in that business cycle peaked in the middle of 2006. And the
Okay.
recession didn't officially begin until January of '08, which most people didn't even know at the time. So you had a year and a half of job losses in the earlier cyclical categories before it translated to a broader business cycle
Got it.
recession. And today we have just about 100,000 job losses in those earlier categories. So it's not
So
enough yet.
this is going to be really interesting because, again, I think what we're going to come out of this, again, July 20th is always my call for when all this nonsense and uncertainty clears up. I think what we're going to see in the second half of the year is a pretty big incentive to add jobs in construction, single family construction and manufacturing specifically for obvious reasons, given the big, beautiful bill and, deregulation and all this stuff that we've been promised. So, should that happen, as, we're being told, that's just going to push off any hope of a recession call in 2025 if you see those slightly negative numbers bounce back. Is that what, am I interpreting that correctly?
If that's what happens, then I think that you would be right. It's almost impossible, where I would say it's never happened before, where you have a recession without those categories driving it. So if those categories aren't negative, the economy really cannot spiral into a recession.
Okay.
As
All
we're
right.
seeing it right now, we have job losses in the residential sector, but the job losses are on the contractor side, not on the
Right.
builder side.
Yeah, it's going to be really interesting. This has been such a great conversation. I want to close with one more topic on the Fed. We're going to have you back. I know the audience is going to love you. But let's talk about the Fed. The Fed, arguably is in a tough spot. I said 6 months ago, no rate cut in 2025, which at the time the market was saying 5 or 4 or something crazy. I'm curious, are you in the camp that we might get a rate cut in September, given muted inflation and maybe a job market that is deteriorating? Do you think a rate cut in September is possible?
Yeah, I do. I think the Fed's going to cut rates a couple of times this year.
Okay.
And I think that even with those rate cuts, policy will still be tight enough to continue slowing the economy. So I do think that the Fed will cut rates a couple of times because that shelter drag will keep the CPI relatively muted. But the critical point about the Fed is that in this sequential process of the business cycle, inflation lags. So employment always moves before inflation. So the Fed never cuts rates for inflation. They always cut rates for labor.
Okay.
So the what's going to determine whether the Fed cuts rates or not is the extent of the labor market deterioration. Because, like we mentioned, because of that shelter lag, that core CPI, which is running at like 2.7% right now, is not going to be below 2 by the time we get to September. So they're not
Okay.
going to be able to ever point to inflation and say we're cutting. They're gonna cut rates because the unemployment rate hits a cycle high, which it technically did in the last report by a 0.01%. Almost nothing, but it was technically a cycle high, or jobless claims or things like that.
Well, let's
Ironically,
talk. I want to give people stuff to look at. So
yeah,
should
yeah,
people look
definitely.
at the weekly unemployment numbers? I think we've had a 3-week trend of it growing. Is that what people should look at? Is it the monthly jobs number? What's something that the average Joe should look at to say, are we getting better or getting worse?
So the weekly jobless claims are a good statistic to look at. That's one that I would certainly look at on a week-to-week basis. I don't think you have to go crazy analyzing it on a week-over-week basis. You want to look at like a little bit of a smoother trend.
Yeah,
That'll move
trend. Yeah.
first,
Yeah.
and then better than the non-farm payroll number that everyone tries to guess every month is the actual unemployment rate.
Okay.
It's not a leading indicator. It is certainly a coincident indicator. So the unemployment rate won't tell you where we're headed. You'll get a little bit of that reading from the jobless claims. But as far as a reliable statistic, the unemployment rate is far better than the monthly non-farm payroll numbers. It's not heavily revised. The monthly non-farm payroll are very heavily revised.
Yeah.
So you want to be looking at if you were to take one number from that monthly report that we all stare at every month, unemployment rate would be the most reliable measure of where we are.
Well, let me give you a little twist because I actually think this cycle is going to be proved to be a little different. And close example I have for you is 1981, 1982. It's not the unemployment rate this cycle, which again takes the elevator up and the stairs down historically. I actually think there's a more important number, which is continuing claims. I think this cycle will in historical concept have a muted unemployment rate, sure, we're going to go higher, but let's say below 5.1. But we're going to see continuing claims, which I think peaked at 1.9 something, go to 2.2 and 2.4 and 2.5 million. I think this cycle is going to be highlighted by duration growth versus, some crazy 7.8% unemployment number. What do you think of that? Am I off?
I think that you make an interesting point, and I have a couple statistics that may support your point there. So, in an analysis that we're going to come out with in a couple of days here, we're looking at some of the employment data on a pretty granular basis, and what we see is that the unemployment rate is moving up, but it's moving up extraordinarily slowly. Right? It's creeping up at really a snail's pace, and what that tells us is that hiring is soft. But there's not a lot of layoffs. So
Correct.
the unemployment rate is moving up because hiring is not keeping pace with the labor force entrance, but it's not really a huge increase in layoffs. The second thing that we notice, which corroborates that, is we look at something called the part-time ratio, which is as a percentage of all the people in the economy that are employed, how many of them are working part-time, not because they want to, but because they have no other option. And
Yep.
that is moving higher. So that's
Correct.
another signal that the labor market is not in a catastrophe, but that employers are not really willing to hire a lot of full-time people, and people can't get the jobs that they want. The last measure that we look at is the number of people working full-time as a percentage of the labor force. And that's come down really significantly from its cycle peak as well. That's not, and because, we count if you're part-time or not, that's what the unemployment rate isn't having that really large spike. But what we would call this is that companies are really dialing back their labor intensity. So demand is soft. There's uncertainty out there with tariffs. So people are, cutting hours, trying to fill with more part-time, throttling down their full-time, things like that. That's translating to, weaker internal labor market dynamics. But because they're not actually moving towards layoffs, you're not getting that hockey stick move in the unemployment rate. Should that continue, your point would be correct. We'll have to see, because these are typically precursors to a layoff cycle, but the deterioration, of course, has to follow through.
Eric, you've been amazing, man. Got to have you back on the show. If somebody wanted to follow you and see all the great stuff you're putting out, where do we send them?
Yeah, thanks for having me on. This was an awesome conversation. You can follow me on X at EPB Research, is where I put out a lot of stuff. I have a blog on Substack at EPB Research, or just go to the website, epbresearch.com, and you can find everything there as well.
Do me a favor, folks. Go to X and send him a note saying, thank you for coming on One Ritzel at a Time. That way he'll come back and have chats with us. Thank you, Eric.
Appreciate it. I'll come back anytime.
Thanks.